let's just take a step back at the month of, not just the month of October, but the year to date. We've ended
Mhm.
10 months of 2021 that just zoomed by so fast. We've got 2 months to go. But now, we seem to be at least reaching the highs year to date. What is causing this? And does this rally have legs as we move towards the end of the year?
I think the bottom line here for such a strong recovery is the decline in COVID cases. Um, yes, on a year-to-date basis, we lag relative to our neighbors, primarily because of some surge in terms of number of infections, and that has resulted into lockdowns, and in effect, has prevented us from opening the economy further, and this has basically have a negative effect on the market as a whole. Now, as we've seen, starting to see COVID cases declining, and we've already lowered the alert level from number four to alert level three, and with the continuing decline in cases, um, in terms of sentiment, there has been a significant improvement in sentiment, and this has resulted to a recovery in our market.
Okay. Sir, do we still care about counting the COVID cases? The rest of the world does not seem to be looking at that anymore. You've
Yes.
had resurgence, but they're still opening the economy already. Can you still link the performance of the market to our cases, to the lockdowns, or are we past that already and just moving forward with looking at the next 12 months?
I think with the increasing number of vaccination among our population, the number of cases seems to, uh, in terms of importance, moving forward, it should be lesser as more people are being vaccinated. So hopefully, the level of severity of infection will not be as severe as compared to what we have seen before. So therefore, because of lower severity of infection, so our hospital utilization rate should also decline, and that should allow us to better manage our healthcare facility. I think that's basically what's in store for us. I think the outlook right now is how will the recovery, how the pace of our recovery. I think a lot of the strong recovery we've seen the past 6 months is basically due to expectations how will the company or how will the economy recover. And as you see right now, during the early part of this year, more of the recovery, or more of the stocks that have been performing well are those companies that have been able to be resilient in facing this situation. Now, the second leg is on the recovery of plays or cyclical stocks, such as banks, property, and which have started to become a focus right now um, uh,
Okay.
for,
So
for the market.
Okay, so let's talk about some of these focus sectors and what you call cyclical stocks. One has in focus has been the mining industry. Of course, you've got the not just the issues on the bans on the open pit mining, whether that will be lifted or not, but really just commodity prices surging, energy prices soaring. Is this something that is just a knee jerk reaction to the reopening of the economy? We might be needing more energy, China, importing more commodities, or is this going to be, like you mentioned, something that is cyclical that might be the next, sector to be rallying?
Well, so far, I think the recovery in terms of the commodity is should is looking at is looking to be sustainable. First of all, as the world economy reopens, definitely you see an increase in demand for these materials. So far, we've seen in terms of the basic commodities, in terms of the prices have moved up by high double digit, and with the impending winter season, definitely China, countries such as China, and the Western markets or Western economies will be piling up for this type of fuel in order to you know to to prepare them for the winter season. So definitely, as we are being are exporters of coal, nickel, definitely these companies should benefit from an increase in prices.
Okay, so there's actually room to run here. You're saying it's a fundamental shift. It's not just an exciting moment for them. Sir, what about the banking sector? This has not performed, very well if you look at the amount of like loan growth, and if you look at the provisions that they're putting aside. Can you say that those provisions set aside already, even just at the beginning of the pandemic, will already last them through for all the pain ahead? Or is there going to be more pain to be seen in the banking sector? And if so, how are these reflected in the market prices?
I think the worst is over for the banks. The banks have been fully provided, and considering that the economy is starting to get back on its feet, so therefore you have to expect that loan provisioning or loans that are turning sour should they also decline, and therefore their loan provisioning moving forward should also be reduced. So that should entail better income for the banks. In addition, there are expectations that because of the high inflation, there should be an increase in their terms of the policy rate. So historically, every time there's an increase in policy rate, banks benefit from it in regards to expanding their NIMs. But at the moment, I think as the major driver for growth right now for banks is
Mhm.
as the economy reopens, so people or businesses will need working capital, and that should also lead to improvement in loan growth.